Always use a stop loss. I mean, take your profits when you can. If you're managing your own personal retirement account, or maybe studying for your CFA, or even sitting at a hedge fund desk right now, you have heard this advice.
Oh, absolutely. It's treated as the absolute gospel of investing.
Right. It sounds like basic prudent risk management. Yeah. It just sounds like discipline.
Yeah, it feels so incredibly intuitive that, well, honestly, nobody ever stops to question the underlying math. I mean, we just accept it as this universal law of gravity in finance. You protect your downside, you lock in your upside, and you go home safe.
But what if that exact discipline, like that very specific mechanical rule, is secretly destroying the absolute best part of your portfolio?
That's the big question.
Yeah, so today we are going deep into some truly staggering original research to answer a brutally simple question. When do stop losses and take profits actually help your strategy, and when do they absolutely ruin it?
And we really need to emphasize the scale of the data we're looking at here because it is massive.
Oh, it's huge. We're talking about an analysis built on the CRSP database, which, if you don't know, is basically the gold standard of historical price data for academics.
Right.
It covers 62 years of daily stock data, representing the complete history of the largest 1,000 U.S. stocks from 1963 all the way to 2024.
Yeah, to put that into perspective for you, you're looking at over 731,000 stock month observations. I mean, it is an absolute ocean of market reality.
Vision.
And the headline finding from all this data is, well, it's devastatingly simple. Good ideas need tails. Bad ideas need breaks.
Okay, wait. I have to push back here for a second.
Go for it.
Because I was always taught that stop losses are the ultimate safety net. Like, they prevent catastrophic losses.
Yeah.
You're saying my safety net might actually be a trap.
Well, let me show you what the data actually say.
Okay.
Because the purest way the researchers tested this is through this brilliant thought experiment. They set up the cleanest possible scenario using two impossible investors.
Right, impossible, because they have actual magic powers.
Exactly. So imagine the first investor has a perfect crystal ball. On the first day of every month, this crystal ball tells them the exact 10 stocks that will perform the absolute best over the next 30 days.
Which is the ultimate dream scenario. I mean, we'd all retire in a month.
The absolute dream. But then the second investor has a horribly broken crystal ball.
Ouch.
Yeah. It tells them the exact 10 stocks that will perform the absolute worst over the next month.
So if you look at the research, there's a side-by-side comparison chart that puts the best stocks and the worst stocks right next to each other. And the numbers tell a really clean, honestly kind of terrifying story.
They really do.
So on the left panel, you see the future best 10 stocks with no barriers, meaning no stop losses, no take profits. You just buy and hold them for the month. These stocks earn a massive 33% per month.
Which is absurd, of course.
Right. It's a thought experiment. The returns are mathematically perfect.
Yeah, but watch what happens to those perfect returns when we introduce that so-called prudent risk management. If you apply a standard 10% stop loss to those perfect picks, the monthly return drops from 33% down to 29%.
Wow.
And then, if you add a 20% take profit rule on top of that stop loss, it crashes down to 18.3%.
Okay, let's just unpack this for a second. The exact same safety net that we are all taught to use just chopped away nearly half of the best possible returns you could ever achieve.
Exactly. Half your edge just gone.
But then you look at the right panel of this chart. This is the broken crystal ball, the future worst 10 stocks. With no barriers, these stocks lose a catastrophic 26.6% in a single month.
I mean, that is pure financial annihilation.
You are totally wiped out. And this is the crazy part. When you add that exact same 10% stop loss and 20% take profit to these terrible stocks, the loss actually shrinks to 11.3%.
Right.
I mean, losing 11% in a month is still terrible, obviously. But the barrier just saved you 15 percentage points of pure damage.
And that's the punchline right there. The rule did not change at all. The quality of the idea underneath it changed.
So the exact same rule is basically a lifesaver for bad ideas and a massive value destroyer for good ones.
That is the entire economics of barrier overlays in one picture. The mechanical rule is completely agnostic. It doesn't know if you're a genius or a fool. It just executes.
Just executes.
Yeah.
But obviously, none of us have crystal balls in the real world.
Right, sadly.
So if taking profits is ruining our best ideas in this theoretical setup, We need to know exactly how much return it's costing us in reality.
Yeah, and this is where the researchers introduce a concept they call the alpha tax.
Alpha tax.
Yeah, alpha being your strategy's pure market-beating edge, like the actual skill or insight you bring to the table beyond just riding the market's general upward trend.
And there's this really striking visual in the paper that maps this out. It's a line chart showing this alpha tax, and it literally looks like a set of fishing lines being pulled taut from right to left.
I love that analogy.
Yeah, it's so clear. The horizontal axis moves from a very loose 50% take profit threshold on the right side all the way to a super tight 5% threshold on the left.
The vertical axis is showing how much monthly return you lose compared to just using no take profit at all.
Exactly. And the lines fan out as you move from the loose right side to the tight left side. So let's look at the baseline of zero skill. Just random stock picking.
Free throwing darts at a board.
Yeah. For random picks, the line is perfectly flat near zero. A take profit costs you almost nothing.
Because there's no alpha to tax. Random stocks don't generally have these massive, predictable winning streaks that are worth protecting. You aren't cutting off any genius insight because, well, there wasn't any to begin with.
Right. But then look at momentum. According to the data, a 12-month momentum strategy is the strongest real investable signal out there.
Yeah.
If you apply a 20% take profit to a momentum strategy, it costs you 0.3 percentage points of return every single month.
We should really pause on that because 0.3 percentage points every month compounds significantly over time.
Oh, massively.
And it reveals why this happens. I mean, a momentum strategy relies entirely on riding irrational trends that extend far beyond normal expectations.
Right. You're buying a stock simply because it's going up and betting that other people will keep pushing it higher.
Exactly. So if you automatically sell a winner just because it hit an arbitrary 20% gain, you are actively cutting off the exact irrational exuberance that your strategy is fundamentally designed to harvest.
You're fighting the core logic of your own trade.
Right. And the tax gets far more severe as your predictive power increases.
Yeah, so what about a stronger signal?
Look at what they call a moderate oracle. This is a signal with genuine foresight, but, still a lot of market noise. If you put a 20% take profit on a moderate oracle, the tax is an incredibly severe 7.3 percentage points per month.
3% a month. Wow.
And for those perfect crystal ball winners we discussed earlier, at a 20% take profit, the tax is a staggering 12.4 percentage points.
Vanished into thin air.
Just gone. The fishing line analogy is perfect because the stronger the signal, or the stronger the fish, the harder it pulls that line down when you try to reel it in too early.
So the tighter you make your take profit, the more you rewrite the very nature of your strategy's payoff.
Exactly. What's fascinating here is that you aren't just trimming a little froth off the top of your portfolio, you are mutating the actual DNA of your returns. Let's look at the actual mechanics of why this destruction happens.
Yeah, the economic intuition here is crucial.
Right. Strong signals, real edges, they do not earn their returns by being just a tiny bit right every single day.
No, they earn their returns from a few rare, enormous winners.
Exactly. The heavy lifting is done by the extremes. We call this the right tail of the distribution.
And there's a chart mapping this right tail out. At a massive 30% monthly return, half of that right tail is still alive and generating wealth for your portfolio, assuming you have no barriers.
Right.
But the moment you apply a 20% take profit, that tail has already flatlined to near zero.
You've systematically killed the exact months that pay for all the small mistakes your strategy naturally makes.
It all comes down to skewness, right? Positive and negative skewness.
Yeah, and they show this clearly with a bar chart of return distributions. Really good ideas naturally have high positive skewness. They lean heavily toward producing massive, outsized gains.
But applying a 10% stop and a 20% take profit physically flips the best ideas. It drags those strong oracle signals from highly positive skewness straight down into negative skewness, which is brutal. It's basically like if I'm holding a great stock, using a tight take profit is like benching my star player the exact second they score a hat trick.
Oh, that's a great way to put it.
Right. Just because I hit my arbitrary predefined quota for goals that game, I'm guaranteeing they can't score a fourth or a fifth goal.
And those might be the goals you need to win the entire season.
Exactly.
You are capping your own genius in exchange for the illusion of control.
So, if we are fundamentally mutating our portfolio's DNA and happily chopping off our own upside, what does this actually look like day to day for the positions we hold?
Well, the researchers built this comprehensive color-coded hit rate dashboard to track exactly that. It shows what actually happens to every position under a 10% stop and 20% take profit rule.
And the contrast is striking.
Oh, yeah. You look at the outcome of the perfect bad ideas, and it is almost entirely a sea of red. Those terrible stocks get stopped out almost instantly.
The brake gets slammed.
Right, the bleeding stops, which is textbook risk management. But then you look at the perfect good ideas, and it is an overwhelming sea of green. They hit that take profit ceiling incredibly fast.
Which completely alters your holding periods. I mean, without any barriers at all, investors naturally hold these stocks for an average of about 21 days a month, letting the signal fully play out.
But the barriers force early exits across the board.
Yeah. For the perfect bad ideas, the holding period drops from 21 days down to just 9 days.
The brakes are working.
But for the perfect good ideas, it drops to just 12 days. You're barely in the trade before your own rules kick you out. Wait, hold on, though. Let me play devil's advocate.
Okay.
If I'm taking profits early and hitting that green ceiling in just 12 days, doesn't my overall win rate go up? I mean, doesn't seeing green more often help my portfolio psychologically?
Yeah. That is perhaps the single biggest misconception in retail trading.
Really?
Yes. People assume that taking profits early guarantees a higher percentage of winning trades. But the data absolutely debunks this. Barriers actually hurt the win rate of good strategies.
Selling for a profit lowers your win rate. How does that work?
Take a pure momentum strategy. Without barriers, its natural win rate is nearly 58%. It wins more often than it loses simply by letting the trend run.
Okay.
But when you apply the barriers, you choke off the trades that would have naturally recovered or extended, and that win rate actually drops to around 54%.
Wow. That completely upends the conventional logic.
It really does. But conversely, look at what barriers do for the absolute worst portfolios.
Yeah.
A portfolio of the worst possible ideas has a natural win rate of 0%. It never wins. But with the barriers applied, that win rate shoots up to almost 40%.
40% from zero.
Yeah, because you're stopping out the catastrophic losses so early that the tiny random daily fluctuations occasionally register as a win or at least a mitigated disaster before the end of the month.
So again, bad ideas need breaks. But your good ideas are just being suffocated.
Exactly. You're sacrificing long-term performance just to get a brief, fleeting psychological hit of locking in a small gain.
Okay, so if the data universally shows that these barriers suffocate strong signals, what happens when we look for the absolute optimal setting for a real-world strategy, like momentum?
The researchers actually plotted this out. They created a Sharpe ratio surface, which measures risk-adjusted returns across every single combination of stop losses and take profits for a momentum strategy.
You can visualize this as an incredibly vibrant heat map. The colors range from a golden orange, representing a high Sharpe ratio and fantastic returns, all the way down to a deep, angry red.
Right, which signifies a negative Sharpe ratio, where you're essentially taking on risk just to lose money.
So what's the best spot on the heat map?
Well, the ultimate finding here, the very best cell in the entire grid, is labeled none. None.
No stop loss, no take profit.
0 barriers. That is the mathematically optimal setting for a strategy that actually has an edge.
And the danger zone on this map is glaring. As your take profit level tightens, as you move toward the column representing a 5% take profit, the entire heat map bleeds into deep red.
It becomes incredibly toxic.
Yeah, a 5% take profit combined with a 5% stop loss literally yields a negative Sharpe ratio.
You've taken a historically profitable strategy, and through the sheer force of your own aggressive risk management, you've manufactured your own underperformance.
You turned a money-making engine into a money-losing one just by interrupting it too often.
Exactly. And this brings it all home to what they call the signal quality ladder.
Right, this is a great visual.
Picture a scatter plot that climbs higher based on how good your underlying investment idea is. Down at the bottom, if your signal is terrible, any overlay provides immense value.
The breaks save you from yourself.
Yes. But as your signal quality rises, moving from random to momentum to moderate foresight to perfect the value of the overlay violently turns negative.
The better your idea is, the more destructive the barrier becomes.
That's the golden rule right there.
So the core takeaway for everyone listening to this deep dive is incredibly stark. Good ideas need tails. Bad ideas need breaks. If you have an edge, you have to let it run.
And it matters so much because, well, we live in a world obsessed with disciplined risk management. Applying a generic rule to a brilliant strategy is the fastest way to make it completely average.
Or much worse.
Or much worse, yeah.
So I want to leave you with a final thought to mull over. Next time you go into your brokerage app and you're setting a tight stop loss or a quick take profit on a trade you really believe in, ask yourself a hard question. Are you actually managing your risk? Or are you just secretly admitting that you think your underlying idea is bad?
That is the multi-million-dollar question right there.
Thank you for joining us on this deep dive. We hope it gives you the confidence to rethink the rules of your portfolio and, maybe let your best ideas finally breathe a little. Keep questioning the consensus, and we'll see you on the next one.